This video contains AI-generated narration and visuals. It is intended for educational and storytelling purposes only.
Fraud Files, USA.
In the heart of Wall Street, Lehman Brothers stood tall, a 158-year-old financial titan with global reach. Founded in 1850 by German immigrant Henry Lehman, it started as a small cotton trading business in Alabama and grew into a powerful investment bank. By the early 2000s, Lehman was deeply embedded in the American housing boom. But behind the prestige and skyscrapers, cracks were forming, ones that would soon shake the world. In the early 2000s, Lehman Brothers went all in on the booming housing market. Fueled by low interest rates and investor hunger, they aggressively bought and sold subprime mortgage-backed securities, risky home loans bundled into financial products. The profits soared, but so did the danger. These loans were often given to borrowers with poor credit, setting the stage for disaster. Lehman wasn't just riding the wave. They were helping inflate the bubble. Driven by short-term profits and shareholder pressure, Lehman's leadership ignored the rising risks. CEO Richard Fuld, nicknamed the Gorilla of Wall Street, pushed the company deeper into the subprime market. In 2007 alone, Lehman reported record earnings, over $4 billion. But the numbers masked a growing time bomb of toxic assets. Internally, some analysts raised concerns, but warnings were buried beneath the roar of success. By mid-2007, the housing market began to slow. Home prices fell, foreclosures surged, and the value of subprime mortgage assets plummeted. Lehman's massive portfolio, once seen as gold, was turning toxic fast. Investors grew wary. The company's stock began to wobble. Still, Lehman's top brass reassured the public. Everything was under control. But behind closed doors, panic was setting in. Despite the growing crisis, credit rating agencies still marked Lehman's mortgage-backed securities as AAA, prime, safe investments. These ratings lulled investors into a false sense of security. But inside Wall Street, whispers of trouble were spreading. Lehman's exposure to bad loans was far greater than it appeared on paper. The truth was buried beneath layers of financial engineering and false confidence. In March 2008, investment bank Bear Stearns, also heavy in mortgage-backed securities, collapsed. It was bought by J.P. Morgan Chase in a government-backed fire sale. The financial world trembled. If Bear Stearns could fall, could Lehman be next? Investors began pulling money out. Lehman's stock price dropped sharply. The dominoes were starting to fall, and Lehman was directly in their path. After Bear Stearns' collapse, Lehman scrambled to survive. They attempted to raise billions in fresh capital, reaching out to investors in Korea, China, and the Middle East. But confidence was eroding fast. Major firms were wary. In June 2008, Lehman announced a $2.8 billion loss, its first since going public. Behind the scenes, global banks were quietly backing away. The lifeboats were leaving without them. To calm markets, Lehman used a controversial accounting trick known as Repo 105, temporarily removing billions in debt from its balance sheet to appear healthier than it was. It wasn't illegal, but it was misleading. Executives hoped to buy time. But as insiders leaked details to regulators and the media, suspicion deepened. Lehman wasn't solving the problem. It was hiding it. By late summer 2008, Lehman's stock was in free fall, losing 75% of its value in just a few weeks. Rumors swirled. Insolvency, cover-ups, imminent collapse. Major banks and hedge funds began cutting ties, pulling investments, and halting trades with Lehman. It was a full-blown confidence crisis. In finance, perception is reality, and Lehman's image was now toxic. In September 2008, desperate negotiations to save Lehman failed. The U.S. government decided not to bail out the firm, fearing moral hazard and political backlash. On September 15th, Lehman Brothers filed for Chapter 11 bankruptcy, the largest in U.S. history. The financial world shook as the $600 billion firm collapsed, triggering panic across global markets and the worst economic crisis since the Great Depression. Lehman's collapse sent shockwaves around the world. Banks froze lending, stock markets plunged, and economies teetered on the edge of recession. Governments scrambled to stabilize financial systems with massive bailouts and stimulus packages. The crisis revealed how deeply interconnected and fragile the global financial network had become, and how one giant's fall could bring down many others. The financial collapse wasn't just Wall Street's problem. It hit Main Street hard. Millions lost jobs, homes, and savings. Foreclosures surged, and families struggled to make ends meet. Lehman's bankruptcy was a symbol of broader economic failure, shaking trust in banks and governments alike. The crisis left scars that would take years to heal. In response to the chaos, the U.S. government launched unprecedented interventions. The Federal Reserve and Treasury rolled out the Troubled Asset Relief Program, TARP, injecting hundreds of billions into banks to stabilize the system. These actions aimed to restore confidence, prevent further collapses, and kickstart economic recovery. But debates over bailouts sparked fierce political and public backlash. In the years following Lehman's collapse, lawmakers introduced sweeping financial reforms. The Dodd-Frank Act aimed to increase transparency, regulate risky trading, and protect consumers. New agencies were created to monitor systemic risk. While reforms tightened controls, critics argued they didn't go far enough to prevent another crisis. The financial landscape had forever changed. Lehman's fall taught the world hard lessons about unchecked risk, greed, and lack of oversight. Banks learned to improve capital reserves and risk management. Investors became wary of complex financial products. Most importantly, the crisis sparked a global conversation about economic responsibility, ethics, and the fragile balance between innovation and stability. Beyond numbers and policies, the Lehman collapse had a deeply human toll. Families lost homes, jobs vanished overnight, and dreams were shattered. Mental health struggles rose as uncertainty gripped communities. The crisis highlighted how intertwined finance is with everyday lives and the urgent need for compassion in economic recovery. Lehman's bankruptcy didn't just shake America. Its effects rippled worldwide. Global trade slowed as credit markets froze. Emerging economies faced capital flight and currency crises. International banks tightened lending, causing a worldwide credit crunch. The collapse exposed how deeply connected global economies had become, sparking reforms beyond U.S. borders. The Lehman collapse also exposed deep flaws in Wall Street's culture: excessive risk-taking, short-term profits, and a too-big-to-fail mentality. Many insiders chased bonuses over stability, ignoring warning signs. This culture of greed and hubris fueled the bubble and accelerated the crash, sparking calls for a moral reckoning in finance. Lehman's bankruptcy left over 25,000 employees worldwide suddenly unemployed. Many faced uncertainty and financial hardship. Offices shuttered, benefits vanished, and retirement funds were wiped out. The human cost of the collapse rippled through communities, highlighting the fragile nature of even the largest corporations. The Lehman Brothers collapse reshaped finance forever. It sparked reforms, changed risk culture, and remains a stark reminder of unchecked ambition. For the global economy, it was a painful lesson in humility and a call to build a more transparent, resilient financial future. The story of Lehman is a warning that still echoes today. Thank you for watching this deep dive into the Lehman Brothers collapse. If you found this story insightful, please subscribe to Fraud Files USA for more eye-opening investigations into the biggest financial scandals and frauds. Hit the like button and turn on notifications so you never miss an update. Stay informed, stay vigilant, and we'll see you in the next video.